We think it has legs. It could always be stopped by a more hawkish Fed. But, thank God October's over. November, Dom, and everyone just talked about the good numbers there, seasonality. So good economy, good earnings, share buyback. So we see more upside for this market, at least for the next 2 or 3 months going forward.
So what do you think, Bruce? Do you think we've broken the downside momentum?
Well, I don't think we've broken the downside momentum. Typically, that requires a day or 2 days, even where upside volume exceeds downside volume by a ratio of 10 to 1 or more. We haven't had one of those days all year long, and yet we've had 7 episodes where downside volume overwhelmed upside volume. So the momentum is still to the downside in our opinion. Now, with that said, seasonals are very strong going into year end, and the market has a good history of rallying post midterm elections. So it wouldn't be too surprising if we had about a 50% retracement, which would take us back toward 2,800 on the S&P 500. But with that said, I think the environment certainly has changed, and I think that's what the market responded to in October. One, we had rising interest rates where they went up to levels we hadn't seen in several years, and in some cases now our competition for stocks.
Right. 2,
the growth rate of earnings, while they're exploding in the third quarter, they have exploded all year long. I think the markets are looking to 2019 for perhaps a deceleration in earnings growth.
Sure.
And that would be a big deal.
And Bruce is positioned defensively, utilities, consumer staples, and healthcare. Joe, I noticed in terms of the sectors that you like, it looks like a growth theme here. Automation, global healthcare, defense.
Yeah, we like that, Melissa. I mean, really, when you look outside the United States, look at kind of the long-term trends. Global obesity is a huge issue. It's good for healthcare companies. Automation, I mean, here in the United States, we don't have any workers or worker shortages, even in China, Germany. So anything that helps companies substitute labor for capital is a winner long term.
You mentioned global 2 times, though, Joe. I mean, are you worried about some of the PMIs that we've gotten out of China as well as Europe, that maybe the global growth is worse than what we're seeing here in the U.S.?
Well, no doubt we're growing faster than the rest of the world, but I still think the European Union can chug along at 1%, 1.5%. That's a lot of output with an $18 trillion entity. And China's slowing down, no doubt about that. But this is already baked into the price. So, Melissa, think of it that way. We know this. It's expected. So I think we go into 2019 with lower expectations, but more upside for a lot of these sectors that are out of favor right now.